Eli Lilly. We've all heard the name. It's the giant drug manufacturer that's been in the news for the past 2 to 3 years since these GLP-1 drugs have become super popular. If we look up year to date, Eli Lilly is up 56%. So far outperforming the S&P 500, one of the best performing stocks in that group actually. So actually, if we look at the best performing stocks this year up to today, Eli Lilly is number 37 in the overall market. Okay, fine, that's impressive. For the past 3 years, Eli Lilly is number 33 in the entire stock market. Over the past 5 years, it's number 31 in the entire stock market, and it's number 23 in the entire stock market over a 10-year time horizon. So, needless to say, this company and this stock has minted probably a lot of millionaires over this period of time. These types of returns and the consistency of them is just amazing. And if we look at the largest companies in the world, Eli Lilly today is the 11th largest company. Today, it's worth more than giants such as Walmart, JP Morgan, ExxonMobil, Visa, etc., etc. At this point, I wouldn't blame anyone for thinking that this company has just delivered so much and that they'll keep delivering incredible returns year in and year out. But unfortunately, in this video, I'll be sharing a word of caution with anyone that either owns the company in their portfolio currently or that is maybe thinking of buying this company due to past performance. So with that being said, let's do a deep dive on Eli Lilly. We're going to be looking at the company's moats, the profitability, and the safety in RatedA style. And then we'll finish off with an attempt at valuing the company. So the way Eli Lilly makes money is relatively simple. They develop and they manufacture and then they sell medicinal drugs. However, this industry in general, the pharmaceutical industry, is very complex. There's many caveats, many twists and turns. It's not always that easy to understand and to predict what's going to happen, but we'll get more into that in just a few minutes. So Eli Lilly makes these drugs that are primarily focused on oncology, which is cancer, and diabetes. So why did they choose these two categories? Well, my idea is that these are two of the most profitable segments. As populations age, people need more medications, cancer becomes more and more prevalent. Also, our diets are getting worse, and people are getting richer around the world and having more access to not the best food. And so, diabetes and cancer, two big categories. So, the company's main medications are listed here. I'm not going to go through all of them, but the top three are Trulicity, Mounjaro, and Verzenio. Trulicity and Mounjaro are two diabetes medications that, if I'm not mistaken, are used as injections and can be used for weight loss as well. So this might be why they're at the top of the list. And then Verzenio is a breast cancer medication. And as you can see here, most of the company's revenues are generated in the US. And given the US healthcare system, I'm not too surprised by this. Most pharmaceutical companies, even the ones that are not based in the US, make most of their revenues in the US. And so 21 billion in the US and 12 billion outside. So about 60% of Eli Lilly's revenues come from the US. So that's a very important market for them. So first, let's analyze Eli Lilly based on the first pillar of the RatedA method, which is Moat. In other words, how well can Eli Lilly defend its returns or its profits from competition over a durable amount of time? Now, usually with pharmaceutical companies, the most famous type of moat and the one that first comes to mind is patents. So pharmaceutical companies, they develop molecules that they then market. And these molecules, the hard part about them is to discover them. It's not actually to manufacture them. So say if the structure of a molecule that was created by Eli Lilly came out and was available for every other company to see, then they could quite easily replicate that same molecule and sell it to patients, and then that drug would essentially become a commodity overnight. So these pharmaceutical companies write up patents to be able to protect their intellectual property, which are these molecules. Now, there's a few things to know about patents. The first is that it guarantees the company a monopoly on that molecule. No other company will be able to copy it and to sell the same type of molecule to treat the same type of disease while the patent is in place. However, patents must be submitted before the start of clinical trials, and patents only last 20 years. The second thing to know is that patents have a fixed term date, which is usually 20 years. Now, when you get to the end of that, it's possible to get extensions. Also, pharmaceutical companies have a whole bunch of tricks that they use to maybe improve the molecule just a little bit to get a new patent started on it. But for the sake of this video, let's say that patents are timed. So these pharmaceutical companies are kind of running against the clock. As soon as the patent is submitted, time is ticking. The third thing to know is that patents are not bulletproof. And as a matter of fact, anyone can submit a claim to regulators to challenge the patent. And so a pharmaceutical company might have a patent and expect profits to come in for 20 years for a certain molecule, but then only realize after year 5 that the patent has been challenged and now every competitor can copy their molecule. So that's a risk to keep in mind. And so here we can see Eli Lilly's list of patents. And for example, for a drug like Jardiance, which I believe on the list was number 4 or number 5 in Eli Lilly's top drugs by revenue, this patent expires 2028 in the US, 2029 in Europe, and 2030 in Japan. So it's not like Eli Lilly will lose this product from its product line in 2028. However, as soon as 2028 hits, all the generic manufacturers can essentially copy the molecule and sell it for much lower prices. How are they able to sell for much lower prices? Well, that's because they don't have to go through the same process of clinical trials as Eli Lilly would have done. And so here you can see you have all these phases of discovery. The main clinical trial phases are phase 1 to 4. The main thing to know about clinical trials is that they're very costly and they take a very long time. And so at the bottom here, you can see sort of a timeline. In the best case scenario, you can expect these clinical trials to last 5 to 10 years. In the best case scenario. So what this means is that as soon as the company comes out of clinical trials, well, 10 years of the patent has already expired. The company has a few ways to use that as an excuse to extend the period of the patent for a few more years, but it just goes to show that this patent moat, I wouldn't say is that durable. And so whenever Eli Lilly comes out with a new drug, it has to go through this entire process from start to finish. But even if you pass all the clinical trials, doesn't mean that you'll be able to market the drug at the end. Why? Well, because the clinical trials are mostly made for safety and efficacy. What that means is that the drug must be safe for patients to use, so the side effects profile must be, really good. And also the efficacy has to be there. So, if you go into the trial saying drug XYZ is going to target receptor XYZ in the body, the clinical trials are going to measure how good the drug targets that receptor. Now, let's imagine that the drug ends up having good efficacy and good safety. The next step is to compare the drug to whatever's already on the market. And so you could have a drug that passes the clinical trials, has a good safety and efficacy profile, but because there are other drugs on the market that do about the same job, that drug won't get, the stamp of approval from the regulatory bodies. So all of this makes it that it's a very dynamic business overall. Now, what if Eli Lilly finds a really good drug in a really good category, such as cancer or diabetes? For example, with the GLP-1. Right now, Novo Nordisk and Eli Lilly are both killing it with those drugs. Well, what's going to happen is that other companies are going to look at that and want a piece of the pie. So now all of the R&D budgets for all the big pharma companies are going to go towards that category. And then even if Eli Lilly has a successful drug in that category, it's now going to have to compete with all these alternatives. And that would drive the returns down, right? So in terms of a moat, yes, the patent, once again, gives a monopoly on that molecule specifically, but that doesn't mean that competition can't either challenge the patent or come in with a different molecule entirely. Now, the second main moat, which, in my opinion, is the durable moat with Eli Lilly, is the size of the company, the scale. Because, like I said before, running these clinical trials is very, very costly. And a lot of the biotech companies, all these laboratories that are in universities or just startups, they don't have the dollars to take a drug from phase 1 of the clinical trials to phase 4. And so, as one of the biggest and baddest companies in this industry, what Eli Lilly can do is simply buy out promising molecules. And that's what they do. So, that's how the top 10 or 15 pharma companies in the world are able to stay at the top in a little oligopoly of sorts. And all the biggest drugs in the world, come from their laboratories in one way or another. Because at the end of the day, scale also allows you to miss some bullets. So if you're a biotech company and with limited funding and you're banking on one molecule, it's almost like a lottery ticket, right? You have to get it through phase 4, and it's the event is like a switch. It's either on or off. So either you make a lot of money or you lose a lot of money at the end. And I think the pass rate for clinical trials overall is about 10%, give or take, which means that in most cases, the biotechs end up losing. But if you're a big company with scale like Eli Lilly, you're able to diversify and miss some chances as long as one or two of them out of 10 becomes, a multi-bagger, so to speak, then you'll be fine. In the pharmaceutical terms, they're called blockbuster drugs. It's these drugs that manage to end up coming out of phase 4 clinical trials and that end up having more than 1 billion of sales per year. So, in many ways, getting a blockbuster drug is the holy grail for these pharmaceutical companies. So, that kind of gives you the big picture with regard to Eli Lilly's moat. Remember, if you want more information, the entire report is on RatedA. So, I'll leave the link to the platform in the description of the YouTube video. Now, if we look on the ROIC and the ROCE for Eli Lilly, which in many ways is a measure of a company's quality, what type of returns the business is able to generate intrinsically, we can see that it fluctuates quite a lot. In the good years, it can go all the way to the 30s, and that's when the list of drugs for the company is really large, really long, the patents aren't expiring, the company has lots of blockbuster drugs in its portfolio, and times are just going really, really well. But then, once a patent cliff arrives and lots of those drugs end up, falling off that cliff, generics come in, then the returns can go down very quickly. As we can see, that was like a period of 4 years when the ROIC went from the high 30s all the way down to, nearly 10. Great. So we can finally move on to the second pillar of the RatedA method, which is profitability. If you're a long-term investor that looks at quality companies, then you just have to look at the future cash flow generation that these companies will produce. So for Eli Lilly, just like every other pharma companies, the main thing to look at here is the drug pipeline. And here, what I can say is that what the market is most excited about clearly is tirzepatide, which is the drug molecule for Mounjaro and Zepbound. It's already been approved for obesity, and it's in phase 3 for cardiovascular outcomes, heart failure, morbidity and mortality in obesity, obstructive sleep apnea, higher doses, non-alcoholic steatohepatitis. So Eli Lilly is trying to get this molecule approved for many types of disease states, which will, in a way, open up the floodgates for doctors to prescribe Zepbound and Mounjaro in many different cases. And of course, this is exciting for Eli Lilly. It's also exciting for the shareholders and the market because clearly this will boost profits in the short to medium term. The other one that the market is finding very exciting is donanemab, which is for early Alzheimer's onset. So that's another one to look out for. But like we mentioned before, in the pharmaceutical industry, it's all a balancing act. And while the company is releasing all these new drugs and these new indications, it has to balance that with the drugs that are coming off patent. And so I mentioned Jardiance already, which is coming off patent in the US in 2028. That's the fourth drug by revenue for Eli Lilly. Even more important is this one, Trulicity, which is currently the highest revenue drug in Eli Lilly's portfolio, which is losing the patent in the US in 2027. So remember, Trulicity is making around $7 billion per year. And so for the company to just stay even from a revenue perspective, they're going to have to kill it with all the ones in the pipeline that are coming up. Looking at the company's financials, we can see that Mounjaro and Zepbound are already having their effect on the revenue with this spike in 2023. And as we'll get to in a minute with the multiple, the market is clearly expecting this to shoot to the sky. And something that's quite surprising is that if we take the period from 2008 to 2022, the free cash flow growth has been zero. As a matter of fact, the company made more money in 2008 than in 2022. And remember, free cash flow is gravity for a company's valuation. To shareholders, the free cash flow is what determines what the company is worth. But once again, we'll get to that in a second in the valuation section. All right, guys, if you made it this far, congratulations. We're now moving to the third pillar of the RatedA approach, which is based on safety. How predictable and how reliable are the company's future free cash flows? And are there risks that could change the idea we currently have of the first two pillars, which are the moat and the profitability? Is there anything that could happen to change Eli Lilly's competitive profile and its profitability? The first thing to mention here is research and development. Look at the difference between Eli Lilly's gross margin and operating margin. The reason why the operating margin is so much lower is because every year Eli Lilly has many expenses related to acquisitions of promising molecules and also research and development, which, for example, means taking drugs through clinical trials. And so every year, Eli Lilly is sinking many billions of dollars into these activities, which don't have a guaranteed return at the end of the day. You know, the company could spend 8 years taking a drug from phase 1 to phase 3 of clinical trials and then have the molecule fail. And that, of course, is worst case scenario for any pharma company. But that, of course, lowers the safety profile of a company like Eli Lilly. The second thing we need to talk about is the dynamic nature of the healthcare industry. In the past few years, we've started hearing about these PBMs, which in the United States stands for Pharmacy Benefit Manager. These PBMs have been altering the landscape a little bit and making the price of most drugs go up. Basically, they negotiate the prices between pharma companies and insurers and the patients. They're in the middle of all that. But they've been taking a larger and larger cut for themselves. And so this has caused the price of many important drugs to go way up, so much so that the government has had to intervene. Earlier this year, the government in the United States announced a mandatory price cut on 10 of the most prescribed drugs in the United States. And lo and behold, in this list is Jardiance. And this is not an insignificant price cut. This is 66%. So yeah, Jardiance is one of the company's top 5 drugs. So yeah, Jardiance is Eli Lilly's fourth largest drug. It's coming off patent soon. If the list stayed at these 10 drugs, then maybe the risk would be low. But something tells me that the government is not going to stop here and that in the coming years, we'll see more and more lists and mandatory price reductions of some important drugs. Then for a company like Eli Lilly, we also have to consider the long-term risk of litigation and lawsuits. Because after all, the company sells molecules that go into people's bodies, which could end up, seeing them have side effects or even deaths in the worst of cases. But for example, Eli Lilly is coming out with this platform to go direct to consumer for the GLP-1 drugs that are very popular at the moment. And so now, if a patient wants to be prescribed a GLP-1 for weight loss, they won't have to go to their doctor to get a prescription. They can get a prescription from Eli Lilly's doctors. How convenient. But at the end of the day, Eli Lilly is incentivized to make money. And so you best believe that they'll be prescribing these GLP-1 to as many patients as they can. But as a long-term value quality investor, you have to plan for the worst case scenario. What if we discover 10 years down the line that these GLP-1 drugs have some unanticipated adverse effects? Then what? These are all possibilities that might not seem too likely to happen tomorrow or next week or next month, but they could happen someday in the future, and we need to discount that in the quality of the company. Other than that, the financial health of the company looks good. The debt has been going up, but not faster than the assets. Interest coverage is going down, which means the company is having to use more and more of its free cash flow to pay down interest, which might be worrying if this trend continues in the future. So keep an eye on that. But that's it for the company's quality. Eli Lilly gets a C overall, 3 for the moat, 3 for the profitability, and 2 for the safety. If you want to understand this rating more in detail, by all means, the analysis is there on the website. And if you don't agree with the rating, please, I invite you to write a comment on this video to explain your point of view and your perspective. If you're thinking of investing in Eli Lilly today, I think that most of the risk you're facing is valuation risk. The current price of the stock is 929, and the free cash flow multiple is 5,000. The reason why it's so high is because 2023 was an aberration and the company made pretty much no free cash flow that year. But if we assume that the normalized free cash flow for Eli Lilly is $6 per share, then that still brings us to a free cash flow multiple of 150. Let's do a very simple calculation. A normal multiple for a decent quality company is 20 times the free cash flow. For Eli Lilly to get to that, at the current share price, the free cash flow per share would have to go from a normalized amount of $6 to 46. That means Eli Lilly needs to multiply its current free cash flow by more than 7 times to get to that multiple. Now, yes, there's a lot of drugs in the pipeline, and the GLP-1 molecules are very promising. The total addressable market is potentially huge. People are talking about these molecules curing anything from depression to addiction and so on and so forth. But keep in mind, Novo Nordisk is developing their own, Pfizer and others are also coming to market with their own that are in clinical trials. So it's not like Eli Lilly has a complete monopoly over this category. And if there ends up being such a huge total addressable market for GLP-1 drugs, odds are competition is going to come in and develop their own molecules to rival Eli Lilly's. Another clue we have that this company might be overvalued at the moment is the free cash flow multiple history. Back in 2014, this company was trading for a 16 free cash flow multiple. And like we mentioned, today it's at around 150. To me, that screams overvalued, stay away. And if you're a value investor, odds are you're feeling the same way. But let's input some assumptions and see what types of returns we could get for the next 5 years for Eli Lilly. The current price is 929 per share. I've already input the current revenue. The growth rate of the revenue has increased recently. So I'm going to be extremely generous and say that it's going to be at 17% for the next 5 years. Eli Lilly's free cash flow margin is usually around 20, let's say. So assuming that the company manages to improve that, let's give it a very generous 25. Shares outstanding are currently at 900 million. Let's be extremely generous and say that the company will buy back 50 million shares in the next 5 years, which at the current price and the current valuation of the company, I'm highly doubtful that this is actually going to happen. But just for the sake of this calculation, let's put in 850. Terminal multiple. Today it's at 150. There's no way I'm going to put that in the calculator, but I'm still going to be generous and put a multiple of 30. Now, finally, the dividend growth has been around 15% for the last 5 years. Let's assume that the company keeps that the same. And we get a total CAGR of minus 3% for the next 5 years. And this is with extremely rosy assumptions. If I was making an actual investment, I would want to be a lot more conservative with my assumptions to give myself a margin of safety. So there it is. Eli Lilly is a company with very good prospects, but it's in a very complicated sector, which is the pharmaceutical sector. Considering the company's average quality and the current free cash flow multiple, I would stay away from this company. This is not to say that the company's stock price is going to go down or it's going to crash. I'm not wishing that on anyone. However, I do think there's many other better opportunities in the market today, and that if you're a long-term value investor and you really want to own this, I think you'll be better off waiting for a pullback. At the end of the day, we want to own high quality companies, but at a fair price.